What's up, everybody? You are listening to the Wisconsin Investor Podcast. I'm your host, Corey Raymond, and today you guys are stuck with me on a solo episode. So before you turn it off and go somewhere else, hang in there, because what if I told you that you could buy a property, pull your money back out, and keep building wealth over and over again? That's what we're going to get into today, guys, how to build some massive wealth. So with that, one of the things I always like to plug is Wisconsin Discount Properties, who sponsors this show. At Wisconsin Discount Properties, we put off-market deals in your inbox every single Monday morning at 6 a.m. And a lot of those deals that we put in there are deals that you can utilize this strategy we're going to discuss today on the episode. So for those of you guys listening, I'm going to do my best to describe some things. Those of you guys watching on YouTube, I'm going to have some different screen sharing I'm going to do here in a little bit and walk through some different things to illustrate some of the points that I wanted to make today on the episode. So without further ado, let's get into it. And if you've been in this game for a while, you can probably guess where I'm going with this episode. It is my favorite strategy in real estate investing, and it is called the BRRRR method. We've been talking in the last few episodes about a BRRRR course that I have. We're now giving it away for free. So if you join our buyers list at wisconsindiscountproperties.com, you can talk to Connor or Reese on our team, and they'll get you set up with the course for free. So check that out. But this is one of the most powerful strategies in real estate investing. And here's why it's powerful. A couple things. You can force appreciation through rehabbing these properties. So what we're talking about here is the BRRRR, and it's an acronym. And so again, for those of you that are experienced, you're like, oh, I know the BRRRR. This is going to be elementary. I already know all about this stuff. Hang on, tune in. We're going to get into some examples. We're going to hopefully light a fire under your butt today if you're not utilizing this strategy or you've slowed down on it a little bit. Like myself, actually, when I do this episode, I'm like, gosh, I got to get doing more of these things, right? As I look at the numbers in particular, which we're going to get into today, I've got some examples to show you guys that are pretty powerful. But it stands for buy, rehab, rent, refinance, repeat. Okay. And I could get into all the semantics of how we're going to do that. We'll see how long this episode goes and if I get into some of those details. But essentially why that's powerful. If you were to go and buy something on the MLS today, right, and it's turnkey, there's no rehab needed, the rents are at market rent, you're going to put 20 to 25% down on that property. Okay. So if you've got a limited amount of cash available, you are putting the money down on that property, and then that money's going to sit there for a while, right? That property now has to appreciate. Your tenant's got to pay that debt down far enough that you could refinance that property at some point and pull your capital back out if you wanted to recycle that money. So for most people, they don't have briefcases full of cash just sitting around to go invest. And so when they start plotting out their real estate journey, they look at things, they say, man, I would love to get to, say, 100 units, right? But I don't have that kind of cash sitting around, to get to that number. That's a lot of down payment money to put in. Okay. And again, that doesn't count any kind of CapEx that would come up and other things like that. And so what this strategy allows you to do is utilize a smaller amount of cash. It doesn't have to be your cash, right? You can borrow that money from a friend, family member, somebody in your network that's willing to give it to you. HELOCs are a great option to use for this money. You use that for a short period of time. You rehab the property. You get the rents up to where the market rent is. Then you refinance that property. And why that's important, when you go to purchase a property, banks are going to look at it typically. Now, there's commercial lenders in Wisconsin, thankfully, that are pretty creative. And so if you have the right connections at some of these banks, you can avoid some of the steps in this process. But traditionally, how it works is they are going to require 20 or 25% down off of the purchase price or the appraised value, whichever is lower. Okay. So what they're saying is, let's say you got a great deal on a property. You bought it for $50,000, right? Right now it's worth $100,000. Traditionally, banks are going to they're going to lend off of the $50,000 mark. They don't care that you have all this equity in the property at purchase. So you have to buy it. Then you would have to refinance it anyway if you wanted to pull that money out. Most people just leave it sit. Okay. So what this allows you to do is you're recycling capital. So you buy it, you increase the value, and as quickly as you can do that, you refinance the property. And now let's say it appraises at 100,000. Well, now most banks will lend 80% of that number. you now can get $80,000 back, right? So now you can go do another deal and do another deal and do another deal. So it's a very, very powerful, very, very powerful strategy. Okay. It also allows you to build a lot of equity over time, right? So it's not a huge cash flow deal, right? You're not typically going to do this for cash flow. You're going to do this to build equity. Okay. There's some tax strategies involved. We did a couple episodes on that, so I'm not going to get too much into the tax strategy piece of this, but just know that that is another huge benefit to doing this strategy is some of the tax benefits, especially if you can consider yourself a real estate professional. And so overall, to build wealth, again, not cash flow, to build wealth, this strategy is tough to beat. All right. Now, a lot of people out there, especially outside of Wisconsin, are going to turn and they're going to say, you can't do this strategy anymore. It doesn't work. Right. And what are they saying? They're saying you can't find deals that make sense anymore to do this on. They're going to say that, you're going to have money stuck in the deals. There's no way you can get all of your money back out of them. And that's not true. Right. We have case study after case study that we've done on deals that we've sold through Wisconsin Discount Properties where people are pulling all or at least the majority out. They might have 5% stuck in the deal versus 25% plus all of their rehab money. Right. So there's still a lot of opportunities here.
Yeah. I mean, it made like no sense to me at first. Right. Because this is my first go around doing stuff off market, even though I've always wanted to. How they do it is they say, hey, or I'll address it like this for somebody that's maybe never bought a property. Your parents probably bought the house that you grew up in, your home, through a realtor on market. The idea is like you're going to pay what's called market value, so you're going to pay a little more, but the condition should be really good, listing ready, right? Like there really shouldn't be much post-purchase rehab you need to do that aren't improvements, which is great. I mean, when I want a primary residence, I'll probably buy whatever through realtors, fine.
Yep.
But what you're not getting is the discount, right? And how do you get a discount? Well, you remove the middleman, and not to be harsh, but you can't list certain properties because the condition is terrible. Like if you had a water line break and there's big holes in your ceiling, no realtor's going to list that. They're not crazy. So as a seller, you go, man, I think I'll take a little less to move on, and that's where you can get your discount. Is that relationship right there, and that's what WDP excels in. So the idea is like, instead of buying it through a realtor, I'm going to work with an off-market partner like WDP, and to sweeten the deal, instead of I end up closing with hard money, then refinancing out because I didn't get an appraisal order soon enough. But what these guys will do, they'll say, okay, you got this property. We're investor friendly. We're looking to grow. Like there are certain banks, like I know from back home, there are a few banks in my hometown that they love working with investors, and there's other banks that just aren't quite as interested. So this bank said we're investor friendly. We've done this before. We're very comfortable with, let's say you get approved for our financing. We'll actually close on the property and we'll get it appraised before you even close. And so instead of lending you off of, let's say it's like 75% down to the purchase price or whatever, the all-in price, whatever, they'll look at the post-construction ARV. So you give them your scope of work, a third-party appraiser walks through, the bank lends off that number. So I'm bringing 40% less to closing. And if you say, hey, Mr. Private Money, like that's where, again, you're all in. If you have a really good private money lender, you're probably not paying more than $100, $200 a month on that more or less gap. And you haven't even started construction yet, and you're about to own the asset. So this bank will say, send the appraiser in, get the ARV, lend off that, lowers everyone's down payment. You're going to pay a little more in points. You're going to pay a little more in interest. But it's like, you can either pinch pennies and try to squeeze out a deal later, or you can be Mr. Good and Done. And that's my mantra right now. I'm trying to be good and done. So that's how that deal worked.
Okay. So what I want to do, guys, I want to go through some examples of this. And again, if you have more questions like how to finance these deals, all that kind of stuff, there's the BRRRR course. You can get that for free now. So what I'm going to do, guys, I'm going to share my screen if I can find it. So for those of you guys listening to the podcast, I'm going to do my best. Okay. So we're going to do an example deal. All right. Here's some examples. And what I did, guys, I used ChatGPT. If you've been listening to this show, you know that I'm a huge ChatGPT fan. Okay. But what I'm going to do is I'm going to use an example. So what I said is I have a deal that's $300,000 ARV. Now I actually have a deal that's pretty close to this, and I'm going to talk about a little bit about that deal. Okay, and we're going to get into a little bit of um, what some potential things that can go wrong with these deals too. Okay, so that is a real possibility here, and I'm trying to get my screen to work so that I can read it and make sure I'm doing this appropriately. Here we go. All right. So I said, yeah, I want a deal. It's $300,000 ARVs. Our lenders will refinance 80% of the LTV, which means the loan to value. And I want to show somewhere we break even every year in cash flow and we're focused on debt pay down. So show an example with a 20-year amortization schedule, break even cash flow with a 7% interest rate. So 7% is about what I'm getting quoted right now. It depends on the lender. Some are 7.5%, some are 8% at the time we're recording this. But 7%, if you're shopping it around, typically you can land somewhere around there. And I use a lot of community banks, commercial financing to do these. A lot of those guys are relationship based. So you might get quoted a little bit higher rate right now if you're new to the game or you don't have an established relationship with some lenders, but that's okay. All right. So what we're going to do here, and I wanted to show 0% or 0% appreciation, because you'll hear people say, you can't bank on appreciation, right? And that's very true. You don't want to bank on appreciation. However, I did a solo episode. The last one I actually did was talking about like basically why real estate investing. And what it basically said was, you gotta have some confidence in real estate. Over the last, I wanted to say 76 years of this chart, real estate's only lost value, and this is across the country, so real estate's very regional, but it's only lost value maybe, I think it was 6 years out of 76. So we're saying like worst case scenario, 0% appreciation for 5 years in a row, 10 years in a row, 15 years in a row. And the reason I wanted to do this was just to show the power of the wealth building part of the debt pay down piece of this. Okay. The other important factor to look at here is we're using 20-year amortization schedules in these examples. Okay. Now, what does that mean if you're new to the game? That means that you're going to be paying more monthly. So you're paying that loan off in 20 years versus like a 30-year loan. A 30-year loan is going to spread that out further. So your cash flow should be higher, but you're going to pay less in principal. So the wealth building component of that property is not as strong. So you can play with that a little bit. Some lenders, it's hard to find in the commercial space where they'll lend 30-year amortizations on value add properties, but they are out there. A lot of them, especially when you go to like credit unions, they'll go up to like 25 years. Very common is a 20-year amortization schedule. Okay, so break-even cash flow, very common in this space. You might even be a little bit negative every year, but let me just show you the numbers of why that still might make sense. Okay. So what we're looking at here, we have a $300,000 after repair value ARV BRRRR deal. We're going to do 80% loan to value, 7% interest, 20-year amortization, and a break-even cash flow. So on a 30-year, if you're getting this property, you're all into it for $240,000. That's the goal. Okay. Again, maybe you're at 250, so you get 10,000 stuck into it. Maybe you're, a little bit less. We're just going to run it as if we get a great, perfect BRRRR here. We got all of our money back. We got our $240,000 we stuck into the initial purchase back, plus all the rehab and everything else. We were all into it for $240,000. Our initial equity, when we refinance that property, we get our $300,000 appraisal. We have created $60,000 of equity day one of that refinance. That's pretty cool. Okay. Now what we look at with a 7-year or 7% interest, 20-year amortization, equity after 5 years, we're now up to $92,000. And this is with 0% appreciation. Okay. So I didn't include any appreciation of these situations here. Okay. Equity after 10 years, we are now $139,000. So a deal that you broke even on, you're not making any money every month on cash flow. You now have $139,000 of equity after 10 years. Okay. Equity after 15 years. Now we're getting real close to paying this thing off. We only got 5 years left on the loan. We're at $206,000. All right. Now, chat wanted to give me a full amortization schedule and some charts, which I'll show you guys here that are watching on YouTube. It's just a cool little chart. It just shows you your equity, everything I just described to you. Thank you, chat, for doing that. All right, very nice. Okay, gave me a little PDF. Very, very nice of chat to do that for me. Now I said, show me that same example, but let's add in 4% annual appreciation with the same parameters as the above example. Now, and I did not check chat's math. Sometimes you have to check chat's math, but it seemed like it lined up pretty good here. So our equity after 5 years, now that we added 4% annual appreciation in, so the loan is still the same. We're at a $240,000 loan. We have $60,000 of equity day one. We're at a 7% interest rate, 20-year amortization schedule on our loan. Our equity is now $157,000 after 5 years. That's just adding 4% appreciation to the formula. Equity after 10 years, we're now at $283,000. And our equity after 15 years, remember we had an ARV on this originally at $300,000, right? Our equity now is $446,000 after 15 years. All right. So now we're going to see a little chart here for those of you guys looking here, what that appreciation really does. And what you can see is by year 20, when that loan is paid off, that property is now doubled in value. It's over $600,000 in value, which is 4% annual appreciation. Nothing crazy here. We're not talking about slow and steady now. Some years it may go down. Some years it may be more than 4, but we're going to say average 4%. And we're going to get into some numbers. I had deep research, do some numbers of Northeast Wisconsin and what is the average annual appreciation over the last couple of years. And so we'll get into some of those numbers here as well. All right. Let's go down. I said, add in the numbers. Okay. So it showed us the spread here. So you can see now for those of you guys watching on YouTube, what was the difference in 5 years? So 92,000 was our equity after 5 years with 0% appreciation. We add in just a small amount of appreciation. It's 157,000. So pretty big spread there. You look at the 15 year, you're at 450,000 of equity compared to 200,000. So that 4% annual appreciation makes a big difference. But regardless, even if you have 0% appreciation, 15 years, a deal that you have no money into is now worth $206,000 to you. Well, it's worth more than that, but the equity is $206,000. Pretty powerful. Okay. Now, another thing I always thought, and until I started messing around with these numbers, I thought, man, that 7% interest rate, if it was like 5.5%, I wonder what that would do to my equity. It would probably be crazy, right? My thought is like, I'm paying more principal every month, less in interest. Now, while that affects my cash flow, and I could have done some cash flow scenarios, but for today's purposes, I didn't really want to get into the cash flow component of it and play around with this a whole lot. You guys can do these same things if you have chat. By now, if you don't have chat, you should. You want to get the plus, at least, membership for it. Anyway, the as far as it equates to wealth building, the interest rate is very nominal in the figures. Okay, so I've heard now since interest rates have been higher the last couple of years, a lot of people hanging out on the sidelines, right? BRRRR investors, people who claim to be BRRRR investors, sitting on the sidelines waiting for rates to go down. What's going to happen when rates go down, guys? Rates go down, demand is most likely going to go up. Okay. And that means you're going to have more competition for the same properties. If you guys remember in 2020 and 2021, what happened? We were getting multiple offers, way over asking, everything else. So appreciation is going to go up even higher, in my opinion. I'm not an expert, so I could be wrong. Okay. But what you're going to see is if you buy today at a 7 or an 8% interest rate and you can get that thing to break even with the improved rents, now when rates go down, your wealth just went up if my hypothesis is correct. Okay. So let's take a peek at this. We're going to look at this chart here. If you guys remember the chart from above, this is equity growth with a 5.5% interest rate. Pretty conservative number. We think we can probably, based on everything I read, next couple of years, we'll be back to 5.5%-ish numbers. After 5 years with 0% appreciation growth, you're only at $97,000 of equity. And I'm going to show you guys a little side-by-side chart here so you can see the difference between the 5.5% interest rate and the 7% interest rate as it relates to how much equity you've built, how much wealth you've created. Okay. So here's a little breakdown. It's going to give me some numbers on the screen. We're going to go down to the side-by-side chart here. All right. So what we're looking at, equity, 4% appreciation and 0% appreciation. If you guys see the numbers here, I think I actually had it put the numbers in here for us. Yes, here we go. So when we looked at the chart before, with 7% interest, after 5 years, you have almost $93,000 of equity. After 5 years, at 5.5%, you've got almost $98,000. So only a $5,000 difference in your equity. Scoot way up over here to the 15-year, it really drops off. There's really not a big difference here. You're at $206,000 with the 7% interest rate and $213,000 with the 5.5% rate. So does the interest rate really affect your wealth, ability to create wealth? Not in my opinion. That is so nominal in the grand scheme of things that if you're sitting on the sidelines waiting for interest rates to go down because you're going to build more equity, these numbers would probably dispute that. Okay. When we look at the 4% interest rate thing, same thing. It doesn't really change a whole lot. The numbers are just bigger. At the 15-year mark, the difference is the same. You've got about an $8,000 difference there in equity after 15 years. So not really a big difference at all.
Wisconsin, I know you can get in some areas in Milwaukee, I'm sure, but again, Northeast Wisco, it's very homogenous. You know what you're getting. It's great. People are very calm. And for me, I like that. It looks like an appreciation station for me because I've always heard, Robert Kiyosaki cash flow, and that's good. But what's better is appreciation because I've kind of settled like, man, until some of these assets are paid off, the cash flow may not be phenomenal. But if you have someone else paying down your debt for you and it's appreciating, I learned that lesson out here, 5% on $550,000, $20,000, man, or whatever it is. I don't know. You know what I mean? So that's kind of what I see in Northeast Wisco.
Nice, man. That's awesome. Yeah. And I've kind of coined my little phrase. I'll probably get some t-shirts made up maybe with Wisconsin Investor on there. And we're going to create a little trademark called the Wealth Cone. And that to me is the one of the major benefits of investing in real estate in general, especially if you have appreciation in your market. And the beautiful thing with us in Wisconsin, we don't get those really big highs or the really big lows, right? Like we're going to be pretty steady eddies. So you're not going to get super rich overnight from appreciation like some of the, Western states or the East Coast or some of those things. But also when things tank, you're not going to lose really either, like big cash. Like in 2008, people lost here. Property value definitely dipped, but not nearly as much as, Seattle or Tampa or, Austin or some of the other big markets, right? So it stays pretty consistent up or down. But you're getting, like you said, typically on average, we're 4 to 5% appreciation here. Some years, like during COVID, I think we were double digits for like 3 years in a row of appreciation, which is just phenomenal when you own an asset like that of these big dollars. And when you didn't have to pay for it necessarily, right? Because you're utilizing the BRRRR strategy. Now you might have some money stuck in some of these, right? After you refinance, but it's not going to be your 20% down plus all the rehab, right? So now your velocity of money, your return on your capital is going to be much, much higher because you don't have as much capital stuck into these things, right?
Well, you said something that hits on something I had to figure out when I bought this first deal through Tempe. So it'll be a total of 5 doors. And I realized like I had a really good realtor. He got me all the full seller concessions or whatever it is. So I had no closing costs, which was huge.
Yeah.
And I ended up buying it for, let's just call it right. It was already like 550. And in hindsight, it's like, probably could have gone 20K less. But you look at what that does to your monthly payment versus what 20K does to your cash reserve.
Yeah.
And so I started to learn quickly, man, if I can figure out a way to keep myself light in terms of how much cash I have out, I can plug a lot of gaps pretty quickly if something goes wrong. In examples like you mentioned, or if it jogs something for me, I would rather pay a little more interest right now in private money or even hard money if necessary, because if I were to fund that, it might be 30% of my account. But if a private money brings it up, I may pay a few grand.
Yeah.
So that's something I'm realizing is like, I have this great, cash, just, reserve in a high yield savings account that sits there, and I can dip into it when needed, but better for now because I want to grow. Better for now to leverage other people's money as much as possible, and keep that cash on hand for rehab, to stay liquid, because I'm being reimbursed by some of these banks. So as
Yep.
long as I have the cheddar on hand, I'm constantly getting it back. It might take 2 weeks, but when you have 4 flips going at once, which is going to be the case probably here in about a month and a half, I should have some of these done. Um, I think I'm going to want that cash on hand, if that makes sense.
Now I said, hey, I've talked to some of you guys out there, and I like to talk about your goals. So if you and I have a call, and it's you're looking to either get started in real estate, or you're stuck or something like that, typically I'm going to want to find out, what is your goal? Why are you even doing real estate? Because the why, as we all know, it's the thing that's going to push you when times are tough, right? And sometimes I talk to you guys, and there's been some goals. This has been a common theme. Man, I want to make 100 G's a year. I just want to make 100 G's a year, then I can quit my job. Sweet. Very doable. Okay. But if you're not making anything from real estate right now, it can be a challenge, right? And I'll share an experience with you. I bought my first commercial building or apartment in 2019, I believe. I closed on a 16 unit. I was going from duplexes up to a 16 unit. So it was a pretty big jump, right? And when I ran my numbers, my BRRRR calculator, I was $300,000 higher than another guy who'd been in the game for a long time, right? And I actually reached out to him about maybe partnering with me on it, because I just didn't have the confidence to own, operate, and run a 16 unit apartment building. And his number was, for the 16 at the time, he was in the $300,000 range with how he ran his number. And I'm like, man, this guy is so smart. He knows way more than I do. And that is still true to this day. Very successful real estate investor. He just happened to run his numbers differently than I did. So I had my little BRRRR calculator, and I put it in my BRRRR calculator, and it came out that I could pay, I think it was around $600,000 for this thing, and still build some equity with raising rents. I had to raise all the rents. I was going to have to redo all the units, because, well, not all of them. There was one building that was pretty new. It was four units on the property. But I was going to have to raise all the rents and do a lot of the heavy lifting. It was probably going to be, I figured, about a 12-month, kind of intense with my property manager turnaround. Okay. Turns out I really underestimated the cost of rehabbing 16 or 12 units. Still got a few legacy people there that we've raised rents on and have not had to spend the money on doing it, but it was pretty capital intensive. So that is one thing I've learned over time, is that, you may end up being capital intensive on some of these things, and you might just want to plan for that, to have some extra laying around on these BRRRRs. Point is, I didn't cash flow anything. Every month for 2 years, took anything I made, ended up the next month, it'd be like, oh, we raised rents on this guy, doesn't want to pay it, he's moving out, we're gonna have to do a full turn on it. Like, shoot, well, there goes all my quote unquote cash flow from this month, right? Same thing would be, maybe I'd get a month off, save up a little cash, build up a little money with the property management company. Then the next month, same thing. Guy's moving out, 10 grand. Okay, shoot, keep returning them, right? What ended up happening though is I don't think I really ever had to come out of pocket for anything. I don't think I ever had to fund anything as far as like out of pocket for this property. But what happened was 2 years later, interest rates were at all-time low in like 2021, right? Interest rates are down. And I ended up refinancing that property with a better rate. My value came in, I don't remember exactly where it was, but I do remember I pulled out about $230,000 to $240,000 tax-free from that property, right? Now, if I sell it, of course, I'll have to pay tax and blah, 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 but it was loan proceeds. So it's considered at that time not a taxable event. So in that moment, it's tax-free. So I have $240,000. I did the math and I'm like, man, I had this thing about 2 years. I didn't quote unquote cash flow anything, but 2 years later, I pulled $240,000 out of this thing tax-free. That's like 10 grand a month tax-free that of cash flow. I just had to wait 2 years to collect my check, but doing the math on that, that's basically what it equated to. And so I think about cash flow differently now a little bit, right? If you have a W-2, you're getting paid a good amount of money, and you don't need the cash flow today to live off of, this is hands down an amazing strategy. You should be doing everything in your power, in my opinion, to get as many of these BRRRR deals as possible. Because watch what happens. If you wanted to just make $100,000 a year. I asked chat, show some examples of how someone could be able to buy properties using the BRRRR and those examples we used above to refinance in 5 years and be living this lifestyle that they wanted, right? So give yourself 5 year runway. Say, hey man, I'm going to stick this W-2 out 5 years. How many deals would you then need to buy to pull out $100,000 per year in refinance loan proceeds? All right. So we ran the same example, $300,000 ARV BRRRR. Okay. We're going to buy the same type of deal every year for 5 years. We're going to hold for the full 5 years, then do a cash out on each property after it hits that 5 year mark. And we're going to treat the net cash out proceeds, tax-free loan dollars, as quote unquote income. So this is going to replace this. Now, chat gave us 5 year equity and cash out per property scenarios. Okay. So they have a conservative scenario. This is very, very conservative. 7% interest rate, 0% appreciation. Okay. Then they gave us moderate. They're going to say, okay, if that interest rate comes down to 5.5%, 0% interest rate or 0% appreciation, we're going to call that moderate. Growth, which is where I would anticipate the realistic outcome of this to be. I'm not going to bank on the interest rate going down or anything like that. Even if it does, we saw it doesn't make that big of a difference. Okay. But your growth, this is where I would probably say we're going to look at some of these scenarios as we dive into this a little bit. 7% interest rate, annual appreciation average of 4%. Okay. And then optimistic, the only difference there is a 5.5% interest rate, same appreciation. Okay. So how many properties would you need to buy each year to start collecting at least $100K a year in cash out refis once the first batch reaches 5 years? So I'm looking again, I'm going to go down to the growth model here. The growth model, if you did this, you would only need to buy 2 deals a year to be able to refinance in 5 years and have over $100K. You're going to actually be able to pull out $85,000 of cash from each of those $300,000 properties that you bought today. Okay. And you could start this process now, which is insane. So that's $170,000 a year of tax-free income from buying 2 of these types of deals every single year. Isn't that crazy? I ran this. I'm like, come on, right? It can't be it. And it's true. So in year 6, this is what they're saying. Property batch 1 hit that 5 year mark. So you cash out refi. Year 7, again, you're going to buy 2 a year, 2 a year, 2 or a year. Okay. So if appreciation goes up higher, you need even less doors or less deals to do. Again, some factors here though, longer amortization. So if you do the 25-year loan or the 30-year loan, you're going to have higher appreciation to hit the same number, or you're just going to have to delay a little bit. Or again, we're at $170,000 on these 2. So even if you had 25 years, you'd probably still have enough equity there to be able to do the same scenario with just those 2 properties. Could run that again here in chat, but for today's purposes, we're just going to assume that. All right. So this is a very, very powerful thing. And you can get really set on this then too, right? If you just said, hey, I need 2 deals a year. I need 2 deals that I can BRRRR that are going to give me 60 grand of equity up front, right? Or however you wanted to do that. You can get very, very clear on your buy box with this.
Well, in 2 months, well, man, I'll be honest, like I was able to run numbers and figure out how much I'd have to have out of pocket to buy the deal with the realtor. But once I did the deal, I understood it front to back.
Okay.
And, maybe I'm just not studious enough, but I had to execute a deal. And once I closed on Winford and just honestly like walked through it for the first time, I was like, wait, this makes sense. There's a way I can do this without using all my money,
Mm-hmm.
and I think the light bulb, once I figured out, I think refinancing is important. Once you get it, it's understood. You don't have to think about it again. But until
Yep.
you actually get a banker on the phone, let's say you're working with your bank and dude, Andy at Key is the man. I mean, I told him up front, hey
Mm-hmm.
man, I'm a new investor. You're gonna have to answer a lot of questions. He's been phenomenal to work with. But I had to get him, and Aaron Kramer was another guest to your podcast who's phenomenal as well. He's a mortgage broker, I think.
Yep.
I had to
Yep.
like say, hey man, I'm going to walk through what refinancing looks like, and you need to tell me where I'm wrong. And these guys, I mean, they're great guys. They help you out. But one day I was like, yeah, man, but I can't refi till I'm, whatever. I forgot what it was until 6 months in, and he's like, you can refinance whenever. And
Yeah.
I was like, that done. This makes total sense. Like
Yes.
the money isn't contracted to stay working. It's lending, it's financing. So I think that was it. Is when that light bulb clicked for Aaron and Andy separately telling me, well, you can read, and there's certain like there's like a maturation or seasoning. So you talk to your lender, but for
Yeah.
the deal I've worked out, it's like as long as I execute the scope of work, like I can refinance instantly. And
Yeah.
that is what clicked for me is like, oh, I get it now. Stay in a little bit more expensive money in the short term to get the deal done, maybe even get it all reimbursed in private,
Mhm.
and then refinance out. And what do you call something that you have $0 in, but it makes you money?
We call that an infinite return.
It's an
On
infinite
investment.
return.
Yeah.
So
I love my financial advisor friends, but when I break this down to them, their heads explode when they see the math on it. They go, well, "Wait a minute, what? You're getting a return on nothing? You have no money into it of your own, and it's producing income for you. How is this possible?" Right? It's
yeah, man.
fascinating. It's fascinating. All right. And then I said, okay, hey, appreciation is kind of like I'm just throwing out 4%. I think that's been historically pretty accurate in Northeast Wisconsin, at least. I can't speak for the other parts of Wisconsin. It varies all over the place, but I would say generally speaking, we could assume 4% is probably pretty good. 2020 to 2022, probably way higher. We had some massive growth in prices in those couple of years when rates were really far down. So I said, just give me 2 years. Go back 2 years. This seems to be, from all the agents I talked to, from everybody else, this seems to be a more quote unquote normalized market. Okay. And so I wanted to look, I said, just give me Green Bay, Appleton, Oshkosh, and Manitowoc areas for what has been the actual average of appreciation, and just focus on 1 to 4 unit rental properties. I don't want to get into like commercial stuff or anything else, just 1 to 4 units. And I had it do it. It took 29 minutes for chat to do its deep research. And what we came up with was, over the last 2 years, Green Bay has averaged 5% a year on these rental properties. So it's over 10% over the last 2 years. Okay. Appleton was about 3% a year on average. So 1 year it was 7%, and then the market leveled off and was actually down just a hair year over year. So it averaged out to 6% in those 2 years. So 3% annually. All right. Oshkosh, mid to high single digit rates each year. So median sale price was 7.5% higher in June of 2025 than the year prior. And they're saying an estimate of 6% annual appreciation over the last 2 years is pretty reasonable. Manitowoc area, I did not realize this. Manitowoc has been blowing up. So about 13 to 14% per year average over the last 2 years, which is just insane. All right. I don't know. I didn't dive into why that is. I didn't get into some of the numbers in here exactly to figure out if there was some other factor that we didn't consider, but I would not bank on 13 to 14% per year on average. But that just goes to show that does happen here in Wisconsin. So that gave us some scenarios, right? Now I ran through back down here to see some of the charts. Now, if we applied those updated figures to each of the marks. Now, Manitowoc, they just ran this scenario pretty crazy here. And I don't even think it gave me some numbers, but if you look at the chart, you'll see Manitowoc just blows up. But all of them, either way, you're doing you got a pretty nice updated graph here. The only one was Appleton, which was surprising because I always thought of Appleton as being probably a little bit higher appreciation than Oshkosh or Green Bay, but just goes to show, we're probably pretty safe with our 4% assumption in some of these things.
But no, yeah, it's like I had to go from thinking about cash flow to appreciation because
Mm-hmm.
again, you know, as long as it's covered, as long as the debt is serviced and it's covered, and you make a little bit on top for repairs or whatever, one day those you will snowball your debt and you'll pay off the cheapest asset, then pay off the smallest loan amount, the next smallest loan amount, et cetera, and you're going to actually create real cash flow. Um, but the magic to this is someone's paying your debt down for you. I'm not
Correct.
being taxed on debt. You
Correct.
know what I mean? And to your point, it's like I mean, I don't know, man. From in the construction of these four deals, I bet I'm going to force well over $200,000 probably worth of equity across all four, and then maybe even more with the one in Ocano and in Kalkona. So I don't know that number off the top of my head, but that's what I kind
Wow.
of hang my hat on. That I'm like, okay, am I getting the 1% rule in rent? Meaning, am I getting 1% of my all-in cost to get this deal at least? Um, and then it's like, how much equity am I forcing? Like, how much equity have I built for myself in the last 2.5 months? It's probably more than in the last 3.5 years, you know?
Another thing I wanted to show you guys was over here on offers due. This is the emails that we send out. Okay. So this is, let me look at this. I actually ended up buying this property as well and bird this thing. I didn't actually get an appraisal done. They just went off of my cost and assumed it was going to be higher. So I do have about 10 grand stuck into this deal just because I went with a credit union. They had much better rates than the community banks, and they typically like more stabilized stuff. So I paid cash, and then I just refinanced with a credit union. But because it was within their 6 month seasoning period or 12-month seasoning period or whatever, they had to go off of my cost. They couldn't go off of the ARV. So, and I was fine with it. It's a lower dollar figure, not a big deal. My payment on this thing though is only like $320 a month, and I get 13. I think I get $1,300 a month for this thing. So that was a nice pickup there. But nobody else wanted this one. This one was out to the list for 64.9. Nobody bid on this property. And so those of you guys listening, what I'm describing is there was a mobile home, 1189 Clareville Road in Oshkosh, on about an 0.41 acre lot, kind of out in the country a little bit, and nobody bid on it, so I just bought it, and now it's a killer property for me. Down the same time, I must have been really hungry for some deals. Here was another one. We reduced the price on this one, so the week prior we must have had it out for a higher number, and nobody wanted this one either. So I picked this bad boy up, and now I'm going to tell you guys, here's some of the things to be careful of and considerations with doing BRRRRs. All right. So what we're looking at is 823 Bond Street, upper lower duplex, 2 bed, 1 bath per unit. And the bottom, there's actually kind of a third bedroom. The appraiser actually gave me, I just got the appraisal back yesterday. He gave me a third bedroom down there. So it's really 3 bedroom lower, 2 bedroom upper. Property management's only renting it out as a 2 bedroom on each. And it is what it is. But we're now getting almost 1,100 a month in rent. And I believe the utilities, oh yeah, all utilities are split. So I don't pay any utilities here. Now, if somebody doesn't pay the water, I'm still stuck with it, right? But let me talk about this deal. So I am all into this thing. Probably we had to rehab both units, did a lot of work here. I'm probably into it for 190 right now, maybe 180 on it. I got the appraisal back yesterday, guys. This should have been at least a 240 ARV. They gave me 210. So this is the risk with doing BRRRR. Okay. If you don't have a cash backup, if you don't have private money that could stay in the deal with you, if you're doing short-term bridge loans or anything like that, and that appraisal comes in low, you might be stuck, right? You might be in a bit of a pickle there, and you might have to scramble to get somebody to come help get you some money back, right, to pay off your private lender. So luckily for me, I just did cash on this one. I actually used cash value life insurance policy, which is a whole nother episode we could get into and use that. But now I'm fighting the appraisal, right? And there's a way to do it. I actually used chat again for this, surprise, surprise, to fight the appraisal. But that is a big risk with this. This thing should have been a 240 ARV. I wonder if I actually have my rebuttal on here to see if I can share that with you guys. Let's see. I don't think I have it on this one. So that's a possible risk with these properties, guys, is you may end up with something where your appraisal comes in low and now you're stuck in a pickle with it.
I had all that already squared away. That was all done within, like, we were working really quickly to get the bank I'm working with is great. I mean, they're turning it around quickly. But what I didn't realize is, appraisers have been known to not show up. And so for me, it's like I had all my pre-approvals. I was fully approved. I mean, we were ready to go. We ordered that appraisal like probably 2 weeks later than we could have. And
Yeah.
the idea being, okay, about a week to get an appraisal done, but we had an appraiser no show, and it pissed the seller off big time. And so internally, kind of taught us a lesson about our own process. But as a buyer, I said, man, I benefited absolutely nothing not being aggressive and managing this relationship with my lenders and trying to get the appraiser out there sooner. So it's like, even if you're fully approved, you're pre-approved, you actually get approved once you get these purchase documents and everything squared away, and you're closing in the coming weeks or month or so. Just something that I thought an appraisal would be faster, but dude, it's a third party you can't control. Don't be surprised. They're like the cable guy. They show up, they don't show up, and we worked with an awesome appraiser after that. So, but the idea being, like you said, man, just play aggressively on the front end. Don't leave it to chance.
But overall, guys, the BRRRR strategy, we have over 100 units. We've used the BRRRR strategy on pretty much every single one of them, other than some seller finance deals that we've done where the seller is only asking for 5 or 10% down or something like that. But the vast majority of these deals, we are using the BRRRR strategy, and it allows us to continue to recycle those funds. And we're ramping up our BRRRR stuff right now. We're actually bringing somebody on to do commercial acquisitions. So we've used this in the apartment space. We've used it with trailers. We've used it with duplexes, single families, you name it. You can utilize this strategy anywhere in real estate investing, and it allows you guys to build a lot of wealth very quickly.
For me, it's like build scalable systems. Again, it's like, I think the appliance thing's really interesting, just like the LVP. Like, buy the same brand or buy a similar product on all your properties. Your installers are comfortable with it. They work it with their hands. They know what they're getting into. You get the same quote. So just try to build something that's scalable. I think that is, I mean, do it in Wisco, man. Like, again, the communities are great. Our suburbs here are fantastic. There's a lot of places to live. Like, I would live in De Pere, Schwabenheim, Swamico, Green Bay, all these places I would live in personally. See, I think that's it. When it comes to investing, you got to let go of the vine. Like, you got to find a way to pay someone else to do it, or else you're going to be, pumping and jumping at 1 or 2 deals a year when you could be doing 20.
Yeah.
You just got to have a scalable system, man.
Talk to me about, like, if we have an investor listening to this outside of Wisconsin, they're like, man, I would love to just build a scalable system and get people my installers to be able to work with the same stuff. How do you find, if you're out of state person right now listening, how do you find installers? How do you find these people, the who's, as we always say? How do you find your who's?
The who's, yeah.
This work for you? What's been the success part there for you?
Yeah, a few practical ones. Facebook's fantastic. It took 2 posts on Facebook to get 12, subcontractors hitting me up, and I haven't. It's funny enough, some of them are on our buyers list. Like one of them that's going out there is a buyer that does a lot of GC work. But I would say Facebook's fantastic. Reach out to the guys at WDP. We have a contractor list on our website, lender list, etc., all that good stuff. And we're revamping the website. It's going to be a little bit prettier, easier to navigate. But Reese has all kind of contacts. It's not realistic to keep it up to date all the time. So there may be someone that Reese has worked. Like for me, I may have worked with somebody that I've introduced to Reese,
right?
And he's starting to get circulated amongst us internally, and maybe we want to recommend him out to some of our buyers that we would trust. Example, that Marinette property, the roof looks like it had eczema. It's ugly. It's flaking off. The wind blows a little bit. You see shingles, dust in the wind. You would think that it is like the springs here and the shingles are flying off to plant new houses. I mean, it's awful. That roof's terrible. But WDP already had a roof quote for me through Prestige. The easiest thing, I just called the Prestige guys. They walked me through their quote again. I say, okay, this was literally just handed to me.
Yeah.
So now I have Prestige. I know who my roofing guy is. Installers, it's kind of interesting. Like, it's easier for me to say, like, I like my installer, I'm going to keep using them. But also, I know if he gets hit by a bus, like, I need to have a number 2, a kitchen guy, or I'm sorry, your cabinet guy sort of thing, your countertop guy. Like, I'm posting on Facebook. I'm trying to find the best quote. I think it is a good idea to, at some point, be boots on the ground for a week or so, so you know where you are. I like that personally, but you don't got to do it. If you're out of state, talk to your property manager. Like, they have all kind of recommendations. WDP is great. Facebook's great. Ask for the best Facebook group messages from the WDP guys. Like, they'll tell you all this stuff. It's fantastic.
I appreciate you tuning in with me and listening to my voice for the last 30 some minutes. here, and appreciate you guys always tuning into the episodes. I would love it if you guys could share this today. This helps you, as I say on every episode. Let people know that you're into real estate. Let them know that you're into real estate investing by you sharing this episode. They are going to know that you do real estate investing, and hopefully it helps bring you deals, private money lenders to help finance some of these deals, and build your track record and credibility by sharing the episodes. And it helps us get the word out so we can continue to bring on guests who are going to bring tons of value for you guys every single week. So with that, if you're not on the buyers list, you can go to wisconsindiscountproperties.com, join the list. We just revamped our website a little bit. We're still working on it, so give us a little grace if by the time this thing drops, it's still not perfect. We're really interested in getting you guys quality deals. That's our number one priority, and the website is kind of secondary. I would say the same for you. If you're new and you're sitting out there, instead of going out and doing deals, you're sitting on the sidelines working on a website or getting some business cards or something, just go do some deals first. But you can go out to the website, fill that out, get on the buyers list, start getting some of these deals sent to you. And if you're not ready to get on the buyers list, you can give us a call or text on the website, and we'll be happy to have a conversation with you and just help you, feel out your goals, get you started on a path to build wealth through real estate investing. Thanks for tuning in, guys. We'll see you on the next episode.